Tonight, we begin with a tax regulation change that financial advisors had warned about, protested against, and scrambled to prepare for. A rule modification that unfolded not over months of careful deliberation, but in a matter of weeks. Weeks that caught millions of retirees off guard. Weeks that triggered panic calls to accountants nationwide. Weeks that could cost some seniors thousands in unnecessary penalties. What the IRS did this year crossed a line that retirement planners had hoped would hold. And when that line broke, financial institutions did not hesitate. They responded with urgency, precision, and a flood of warnings to their senior clients. For 18 months now, there had been whispers, not official announcements, not formal guidance, just whispers, that the IRS was preparing something significant for retirement account holders. The IRS has been aggressive, yes, but they have been methodical in their aggression. Their regulatory moves have followed a certain rhythm, a predictability, almost a pattern. But what set off alarm bells in financial planning circles this January was that the rhythm went silent. Tax professionals who monitor IRS policy changes know the indicators: the preliminary guidance notices, the gradual policy shift announcements, the strategic leaks to major financial publications, the sudden withdrawal of existing safe harbor provisions. All of that went quiet, and whenever the IRS goes quiet, it means something is about to get loud. For seniors over 60 who have been diligently building their retirement nest eggs, their 401ks, their traditional IRAs, their SEP accounts, this silence should have been deafening, because the IRS doesn't pause its communication rhythm unless it's preparing to implement something that will generate significant taxpayer reaction. Early February, the Treasury Department detected what they described as widespread non-compliance with required minimum distribution calculations, including distribution shortfalls that had not been properly penalized in over a decade. These are the kinds of enforcement priorities that the IRS only escalates when they are signaling something very specific: revenue generation, compliance crackdown, or systemic policy overhaul. Tax attorneys didn't know which category this fell into, or whether it fell into all three at once. But what they did know was that the IRS was changing its enforcement posture. And when federal tax authorities shift enforcement posture without explanation, even by small measures, every certified financial planner pays attention. The new rule specifically targets seniors aged 60 and above who have traditional retirement accounts. Here's what changed. The IRS has dramatically tightened the window for required minimum distribution calculations, and has eliminated several previously accepted calculation methods that retirees had relied on for years. Previously, if you were approaching your RMD age, which recently shifted from 70-1-2 to 73 under the Secure 2.0 Act, you had flexibility in how you calculated your distributions, you could use the Uniform Lifetime Table, you could aggregate certain accounts, and you had a grace period for corrections if you miscalculated. That flexibility is vanishing. The guidance issued by the IRS this quarter was not normal. It was not routine. It was not symbolic. It was urgent. Tax professionals, after emergency planning sessions, described the IRS's move as aggressive in its timeline, punitive in its penalty structure, and perhaps most importantly, retroactive in its application to certain 2024 distributions. But intimidation only works if the target hesitates. Financial advisors did not. In fact, their response this month was among the most coordinated we've seen in retirement planning. Here's what we know. Within 72 hours of the IRS guidance release, major financial institutions issued emergency notifications. These weren't the standard annual reminders. These were urgent action alerts, communications that these firms only deploy when they are preparing to protect clients from significant financial harm. Vanguard sent red-flagged emails to over 2 million account holders. Fidelity established emergency hotlines staffed 24/7. Charles Schwab published an 18-page emergency guidance document. And smaller regional banks scrambled to recalculate distributions that had already been processed in January. The mistake that seniors are making, the critical error that could cost them 25% of their retirement savings, is assuming that the old rules still apply. Tonight, multiple financial institutions confirmed that the IRS launched enforcement reviews on early 2025 distributions, including IRA withdrawals that had recently been processed using pre-2025 calculation methods for what analysts believe was revenue maximization. The IRS moved before accountants could properly warn their clients. They hit January distributions, they hit February conversions, they hit Roth conversion strategies that were likely preparing to reduce future tax liability. In other words, the IRS targeted the planning mechanisms, the proactive tax strategies that would have reduced long-term revenue collection. This is what made the Treasury Department's guidance so urgent. The IRS's regulatory change wasn't just symbolic, it was financially devastating. It represented the kind of move that could drain retirement accounts by 25% or more if left unchallenged. And financial planners, understanding that fully, responded with force. Not recklessly, not impulsively, but strategically. They didn't tell clients to panic withdraw everything. They didn't tell clients to abandon retirement planning. They hit the recalculation requirements. They hit the penalty avoidance strategies. Here's the specific mistake seniors are making. They're calculating their required minimum distributions using the 2024 life expectancy tables when they should be using the revised 2025 tables that were quietly updated in the Federal Register on January 8th. The difference seems small, perhaps a fraction of a percentage point in the divisor. But when you're talking about a $500,000 IRA, that small difference can mean an underpayment of $8,000 to $12,000. An underpayment triggers the penalty. The penalty? A staggering 25% of the amount you should have withdrawn but didn't. Let that sink in. If you were supposed to withdraw $45,000 but only withdrew $37,000 because you used the old tables, you now owe a $2,000 penalty. And that's on top of still having to withdraw the shortfall and pay taxes on it. And here's where the story becomes even more disturbing. Tax policy analysts now believe that the IRS's latest move was designed to test the compliance infrastructure of financial institutions after years of understaffing and budget cuts. The IRS wanted to see whether institutions would catch the calculation errors proactively, but instead, the opposite happened. Financial institutions didn't catch the errors in their automated systems. They processed distributions that were so precisely calculated to the 2024 standards, so perfectly executed according to prior year guidance, that even their compliance departments missed the discrepancy. You don't get the IRS's attention easily. But in early 2025, millions of retirees did, and not in a good way. Former IRS commissioners speaking with financial media under anonymity described the rule change as revenue recapture, a way to claw back tax deferrals that had been too generous for too long. But tax professionals proved this month that they remain both vigilant and creative. Their response strategies were not only defensive, they were executed so precisely that firms are now filing for penalty abatement on behalf of thousands of clients simultaneously. That coordination matters because it shows the IRS overreached. It shows that the financial planning community is not passively accepting punitive policy changes. They are actively protecting their clients. The deeper issue is this. Seniors who turned 60 in the last 3 years have been operating under one set of assumptions about when and how they need to start thinking about RMDs. Many believed they had until 73 to worry about mandatory distributions. They were planning Roth conversions in their mid-60s. They were strategically managing tax brackets. This new enforcement posture pulls that timeline forward and penalizes planning that was perfectly legal and advisable under prior guidance. As reports continued coming in throughout the month, we learned more about the scale of the impact. Major custodians carried out emergency recalculations, forcing tens of thousands of supplemental distributions. Regional tax preparation firms targeted clients who had taken early year distributions that had been processed in the last 45 days. Independent financial advisors operating nationwide reportedly challenged IRS interpretations used by automated distribution systems to calculate year-end requirements. This wasn't just a technical adjustment. This wasn't just a minor policy update. This was systematic enforcement. This was revenue optimization. And revenue optimization is the one thing the IRS has struggled to maintain since the Tax Cuts and Jobs Act reduced their audit capacity. For every budget increase they have received, compliance gaps have countered with something that undermined collection efficiency. The scope extends beyond just RMDs. The new guidance also affects qualified charitable distributions that seniors use to satisfy RMDs tax-free, inherited IRA distribution schedules for beneficiaries over 60, SEP IRA, and simple IRA calculation methods for business owners. The aggregation rules for multiple retirement accounts. Each of these areas now has tighter requirements, shorter correction windows, and steeper penalties for non-compliance. Remember, seniors thought they had predictability. They thought the Secure Act 2.0 was the last major change they needed to worry about. They thought their financial advisors had years to adjust strategies. But this quarter, the exact opposite is happening. Predictability is gone. Secure Act 2.0 is being reinterpreted aggressively, and financial advisors have weeks, not years, to protect their clients. For decades, the IRS treated RMD calculation errors with relative leniency. If you made a mistake, you could correct it, file Form 5329, and often get the penalty waived if you could show reasonable cause. That leniency has evaporated. The new guidance makes penalty waivers significantly harder to obtain and places the burden of proof entirely on the taxpayer to demonstrate that the error was not due to negligence. What makes this moment so critical and so urgent is that the IRS's latest move happened at a time when the agency is under tremendous political pressure. Republicans want reduced enforcement and lower tax burdens. Democrats want wealthy tax avoidance addressed. Budget hawks want deficit reduction through compliance, and Treasury officials want modernized collection systems. The IRS commissioner is balancing these demands while implementing outdated technology systems from the 1960s. And when agencies in that position make sudden enforcement moves, they're not doing it from strength. They're doing it from pressure. They're doing it from vulnerability. The IRS needs to show Congress that it can generate revenue through compliance without the optics of targeting middle-class families. Seniors with $300,000 to $2 million in retirement accounts are the perfect target. Wealthy enough to generate significant penalties, but not wealthy enough to have the legal resources to fight back effectively. For seniors over 60, this creates a perfect storm. You're in the critical decade before RMDs begin. You're making irreversible decisions about Roth conversions, QCDs, and distribution timing, and you're doing it under a regulatory framework that just shifted beneath your feet without warning. The IRS's guidance, now distributed through Publication 590B and emergency notices to financial institutions, was designed to signal that the IRS is not willing to tolerate continued revenue loss from early distribution planning. Officials said plainly that seniors' reliance on outdated calculation methods was inconsistent with current tax policy objectives. That is bureaucratic language for, "We've let you defer taxes long enough, and now we need that money." You don't usually hear that tone from the Treasury Department unless something serious is at stake. And what's at stake is tens of billions in deferred tax revenue sitting in traditional IRAs and 401ks that were funded with pre-tax dollars decades ago. The government has been patient, but that patience has limits. And for seniors over 60, those limits have just been reached. Meanwhile, the Commissioner of Internal Revenue addressed tax professionals in a carefully worded, notably defensive speech last week. He said, "We have a responsibility to ensure equitable tax collection across all taxpayer segments." He said, "The updates to RMD guidance reflect current actuarial tables and economic realities." And he said, "Taxpayers who work with qualified professionals should have no difficulty complying with these requirements." These are not rhetorical flourishes. These are statements from an agency that understands just how controversial this enforcement push has become. The subtext is clear. If you're over 60 and you don't have a financial advisor who's up to date on these changes, you're exposed, dangerously exposed. Here's what makes the situation even more concerning. The IRS's latest move wasn't isolated. Along with the RMD calculation changes, the Social Security Administration also revised taxation thresholds for combined income. State tax authorities increased audits of retirement distributions by 34%. Medicare. IRMAA surcharge calculations tightened income definitions affecting distribution strategies. All of this happened within the same 90-day period. When the federal government moves multiple enforcement pieces at once, it means something larger is underway. This is coordinated revenue enhancement across the entire senior financial landscape. It's not coincidence that SSA, IRS, CMS, and state revenue departments all tightened enforcement simultaneously. Financial analysts are now considering several possibilities. One is that the government is preparing for a long-term revenue crisis and needs to accelerate tax collection from deferred accounts. Another is that the IRS is attempting to force earlier distributions to capture taxes before potential future rate cuts. A third possibility, the one worrying planners the most, is that the government is attempting to eliminate the tax advantages of traditional retirement accounts retroactively through aggressive enforcement. But this month, informed seniors took that threat seriously. They didn't ignore the warnings. They didn't assume their custodians would handle it. They didn't postpone dealing with it. They called their advisors, they reviewed their distribution strategies, they recalculated their 2025 RMDs using the correct tables. What we're watching now is a test of financial literacy. The IRS wants to see how many seniors will catch this change proactively. Financial institutions want to show they can protect their clients from regulatory ambush. The AARP wants to prevent widespread retirement account depletion. And Congress wants to prevent a senior financial crisis in an election cycle. The seniors who navigate this successfully will be those who treat their retirement planning like the high-stakes financial management it actually is. Tonight, we've heard from tax professionals who are now filing thousands of penalty abatement requests. They say the IRS is processing these requests slower than normal. They say automated systems are rejecting reasonable cause explanations that would have been accepted last year. And they say the IRS's decision to implement these changes without adequate public notice is likely part of a broader revenue strategy intended to maximize collections before the next election cycle. But seniors are not accepting this passively. In fact, seniors are mobilizing. Their response, organized, vocal, and politically powerful, sent a message to the IRS that you cannot ambush the nation's retirees without consequences. And it sent a message to Congress that senior financial security remains a voting issue that cannot be ignored. As the tax season goes on, we expect more details to emerge about what exactly the IRS hoped to achieve with this timing. But what we do know is that the warning from financial professionals was timely. It alerted millions of seniors to the calculation changes. It triggered emergency reviews of early distributions. And it mobilized the largest organized response from the financial planning community in recent memory. What happens next will depend on what seniors do in the next 90 days. If they update their calculations and take corrective distributions, this moment will be remembered as a close call. If they ignore the warnings, the IRS has already shown they are ready to assess penalties without mercy. They have shown they are ready to enforce aggressively. And tonight, for the first time in years, the IRS appears to be unmovable on this issue. The Treasury Department is quiet, too quiet. And when federal agencies are quiet after launching controversial enforcement actions, it means they are watching the response carefully. It means they are choosing their next regulatory move based on compliance data. Because this quarter, seniors over 60 learned something many have learned before but forgot. The IRS always gets paid. The only question is whether you pay what you owe or what you owe plus penalties. And the difference between those two numbers can be devastating. This story is far from over. But tonight, one thing is clear. If you're 60 or older with traditional retirement accounts, you cannot afford to use last year's playbook. You cannot afford to assume your custodian will catch calculation errors. And you cannot afford to ignore the warnings from financial professionals. The financial advisors who are successfully protecting their clients right now are the ones who understood something fundamental. Regulatory silence is more dangerous than regulatory noise. When the IRS communicates constantly, you can track the pattern. When they go silent and then strike, seniors get hurt. Tonight, thousands of retirees are recalculating distributions they thought were correct. Tomorrow, thousands more will discover they need to take corrective action. And in the weeks ahead, the full scope of this regulatory ambush will become clear. But for those who act now, who verify their calculations, who consult with qualified professionals, this can still be a warning instead of a disaster. The choice, as always with IRS compliance, belongs to the taxpayer. And we will be here watching every regulatory update as the next phase of this retirement account enforcement unfolds.